been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is a real estate investor and founder of Derosa Group, Matt Faircloth. Now, under Matt's leadership, Derosa has completed over 60 million in real estate transactions, including apartments, mixed-use buildings, office buildings, fix and flip projects, and tax lien investments. Matt has an extensive expertise in connecting passive investors to lucrative investment opportunities through syndications, private loans, and joint ventures. And so, guys, I'm excited to introduce Matt on here to the show. But before we dive into it with him, I've got a few housekeeping items I want to run through. As you probably heard the last couple episodes, our third mobile home park investment fund just went live a few weeks back, and we've had a great amount of interest. So a lot of pent-up demand. It's been almost 2 years since we had our second fund live that we were taking capital in. And so lots of anticipation rolling up to this release of the third mobile home park investment fund. It's a Regulation D 506C. It's open to all accredited investors. Now, for those that don't know, I guess if this is maybe the first time that you're listening to the show, my team and I, we specialize in mobile home parks and have been doing it for nearly a decade. Way back, I'd like to say way back before a lot of investors knew that this asset class was cool and lucrative. And so it's an amazing investment vehicle, and we absolutely love the space and everything about it. You know, it's now the secret's kind of out. Some of the big boys such as Carlyle Group, Blackstone, Apollo Group, just to name a few of the big private equity players that are in the space. They're in our space, and they're in a very big way. So that should probably tell you something as well. If you want to learn about partnering with my team and I on this latest investment fund, you can go over to our website, sunrisecapitalinvestors.com, and simply click on the Invest with Sunrise button to access our PPM and our offering documents. We've got a number of off-market deals. Super excited about number of the deals that we have in the pipeline. And again, if you want to team up with a group that's been doing it for a very long time, go to our website, sunrisecapitalinvestors.com. Moving on here, guys. If you love what we're doing here at the Real Estate Investing for Cash Flow podcast, and you haven't done so already, please subscribe to the show. That way you get notified when new episodes come out. But then also, please review and rate the show if you haven't done so already. It's how we attract awesome guests such as Matt here to the show. They want to, folks want to see that people like what we're saying, what we're doing here. And Matt wouldn't come on otherwise if we didn't have good ratings and reviews. And so please do that if you haven't done so already. And lastly here, guys, I want to remind you of the free 30-minute phone call I offer each and every Friday afternoon. I set aside 2 to 3 30-minute time slots where I open up my phone line to connect with you. So you can go to my website, kemup.com, to get signed up for that call. And on that call, we can talk about anything and everything related to real estate investing. No ulterior motives on this call. I won't try to pitch you anything. I won't sell you any programs or anything like that. It's just my way of giving back and also a way of connecting with awesome folks that share the same passion for real estate investing that I do. And so with that, guys, I'd like to get on to the guest of the hour, which is Matt Faircloth. So Matt, how you doing today, buddy?
I'm great, Kevin. Thank you so much for having me here, man.
Yeah, man. Excited to have you back here. And as we were chatting about before we started rolling, Matt and I ran into each other. The last time that we physically saw each other was back in February at the Best Ever Conference out in Keystone, Colorado.
Mm-hmm.
Had a good dinner together, had some good conversation. And then shortly thereafter, the world kind of shut down. And so interesting times because it feels like it was so long ago, but it really was. It wasn't 2020.
Just a couple months ago, right? The same year, just about 6-7 months ago. But it feels like about 10 years ago. The world has changed good a bit, but it is good to see you again.
Yeah, same, buddy. I'm glad to have you here again as well. It's been quite some time since we've had you on the show, and I know lots have changed in your life and your business. You guys have been continually growing, doing big things, and so I'm excited to get into that and talk about some of the latest and greatest with your group. But for those folks that might not be familiar with you, Matt, maybe just take a few minutes to tell us a little bit more about you and yourself. Your background, how you got into real estate.
Sure, absolutely. Thanks again for having me here. My company's the Derosa Group, and it's the Derosa is literally my wife's mother's maiden name, and we just thought it was a really good paisan kind of strong name with strength to it, and so she gave us permission to use it for the company when we founded it in 2005. So that's the history of the name, and I in 2005 was when I quit my day job. working for a company called Ingersoll Rand, and my wife and I figured out how to do something that I think that Americans had kind of lost sight with, which is living below your means. We had learned how to live below our means and live off of just her income, and so we lived off of just her income while I could spin off and started our company. Fast forward through some fix and flips, through acquisitions and dispositions and all that, we grew the company. Got through the downturn, stayed primarily in residential real estate, although we do own one office. We own an office complex in downtown Trenton where our headquarters is. But kind of made a home in residential real estate, like sticks and bricks, small multis, things like that. And then after the downturn, we saw an opportunity to expand what we were doing to those that were around us, because people when I told people that I was quitting my job to become a full-time real estate investor, some would say, "Oh my God, you've lost your mind." And some would say, "Real estate investing, that's interesting. Tell me more about that." And so we, it was a good cocktail party, dinner party, Thanksgiving Day conversation with friends and family. And as we grew, people became more curious about it and saw that we were starting to make a living doing it. And they started saying, "Hey, listen, we'd love to join you and do what you're doing too. We just don't have the time to do it. Would you be able to help us put money to work?" And through that inquisitiveness, it was never part of our business plan to raise money from other people. And some would say that it isn't theirs. We just we're trying to build it on our own capital so we could keep everything that we were doing. But through relationships and through curiosity of others, we realized, we really could help more people reach their financial goals and assist those that don't have time to put their money to work in real estate. So we started, doing private loan programs, started doing some small equity deals. That was in 2011. And we went from around 30 units at that time to fast forward to today. 9 years later, when we just closed a transaction in North Carolina that put us over 1,000 doors. We're at 1,150 doors now under management. Super proud to be able to say that. About 250 investors invest with us, small and large. We've done small and large deals. We did not just take a run to the back of the room course and learn how to buy apartment buildings and call it good and just start doing deals. Our first private equity deal that we did with an investor was 2 single family homes. And we slowly scaled it from there. And that's another thing I think the real estate industry has forgotten, is to start small and scale it versus like people want to just, go and buy a 300 unit apartment complex as their first deal. I mean, that's not what we did. We started small and built it organically. So that's us. And we've got a lot of battle scars and lessons over the 15 years of business ownership.
Yeah, well, congrats, buddy. That's
Thank
exciting.
you.
I know that we were talking about that recent acquisition. That's a big one, and we're gonna kind of focus on that today. Not necessarily on the deal itself, you could say, but the capital raising side, because as you had mentioned, you didn't really start taking private capital in until, was it 2011? Was that the year that? Okay,
it was our first private capital.
Yeah, check. And so it started out with 2 single family homes, and then you started doing some smaller multis and smaller checks. But this last one more than doubled your largest capital raise to date. And so we're going to kind of tear that one apart and dive into the weeds on it. But I have a few questions before we go down that road. What were some of the bigger learning points of going from those smaller multis? So I know last time we chatted, I think if I can recall, like you own some 8 units, a 16. I mean, you own some smaller, medium sized properties, but moving to this larger 300 plus space or door property, I mean, it's a big shift. And so I guess maybe share some of the major differences of transitioning from the small, medium to a larger asset.
Sure. It was an interesting journey. And in some ways, from the management perspective, it wasn't that much of a learning curve, because we had already done, I think we have 5 or 6 apartment complexes that have staff on site. Right. And so there is a jump. The first hurdle in real estate is obviously going from small single family up into multi, where you've got tenants that are having to deal with each other, and you have to, as a landlord, deal with tenant issues and maintaining common areas and things like that. So that's a school in itself. Isn't getting into any size multifamily. Then a hurdle from there. And we had been to that school. We own 10 units. I think we had a 10 unit, an 18 unit, 49 unit, all of which, and then a bunch of 4 or 5 units in there. those properties all taught us a bunch. They taught us about direct tenant relations. They taught us about school of thought for collecting rents, school of thoughts for managing property managers, and also for self-managing, because we self-managed for a while in there. We don't anymore, but we did. And I recommend it to any new investor: self-manage for as long as you can stand it, because it'll teach you a ton. So we scaled from there into sites that have on-site management, and that typically occurs over 80 units, 80 to 100, somewhere in there. And so we went from 49 units and took down a 198 unit, and that had 4 full-time staff, on-site leasing office, a whole nother level of complexity. And that was another school that we had to go to teach us and to learn how to manage on-site staff, learn what the KPI, the key performance indicators, for the site staff were, and things like that. Mm-hmm. While we were learning how to raise more and more money, the smaller deals, our raises were somewhere between, first raise was $50K. That was my first equity deal. But the larger ones, like the 49 unit, we raised $1 million. And that was our first really significant pool of capital. The 198 unit that we did was 3.2, and that was our largest capital raise to date, was that one property. And then we did some other raises that were in the mid twos. We had gotten, as a company, really good at raising somewhere between 2 to 3 million. And there is a certain process and school of thought and methodology we had sharpened up really, really tight, to where, again, Kevin, I'm not telling you this upon my chest. I'm not trying to brag. I'm not one of these real estate investor guys that tries to shout from the mountaintop how awesome I am. I'm not. It's not me.
I know you're not that, buddy.
You know me. I'm about as real as people get in this business, and I'm the anomaly, because there's a lot of people that do that in our industry, but I'm not that guy. I'm not that guy. So I will tell you, though, that our last raise before this was called Derosa Capital 10. Derosa Capital 10, we raised $2 million in like 48 hours from launching the deal to, hard commitments. And then wires came in after that, right? 48 hours, which for us, I'm like, holy crap, we just did it. That's amazing. Fast forward to Derosa Capital 11, which was a total raise of $12 million. And so we had to figure out how to change our game and kind of graduate to the next level of real estate ownership, because we had gone through several graduations, let's say, and we had to hit the next level of capital raising, of how to raise bigger pools. And I'm the guy that wrote the book, raising private capital with BP on this.
That's right. Yeah, you did.
Yeah.
Forgot about that. Right. Sorry to give you the plug in the beginning. Yeah.
No, I'll be sure to mention it, Kevin. Don't worry about it. But the book talks a lot about raising money out of your own network, and it talks about expanding and pushing and things like that. But one thing that we had to do was how to go like next level. And the book talks about next level, but we had to just double down on the methodology that was in the book and increase our tech and probably do a lot of things in the book even sharper and tighter to get to that raise. So that was an enormous schoolroom for us.
Well, I want to dissect that. That's going to be the focus here, going from, and just let's back up a little bit, make sure we got clarity. I know you mentioned, so Derosa 10 and Derosa 11. So it was a total capital raise in 10 of 3 million. Then you raised, were you the 3 million?
10 was small. No, that's how we pulled back. It's just, you know what? Okay. Debt got really interesting in real estate the last couple of years, man. I assume mobile home parks that you guys did the same thing, but pre-COVID, the loan to value you could get got even more. It got higher and higher, man, to the point where like we were buying property and, 20% down on the purchase price, 100% of construction funded by the bank. So you needed to raise enough for 20% down your closing costs, your operating capital, whatever fees you're going to take, and your closing costs. That's it. Whereas DC 8 was that was our first really big deal, the Risk Capital 8, and that one was 3.2.
Okay. Got it.
Our raises got smaller, actually. as we bought bigger deals. Believe it or not, Derosa Capital 8 was a $6 million transaction. But as we bought bigger deals, our capital stack, our equity got a little bit smaller because of how favorable financing got. Now that whole world is gone, man. That's another thing that changed on us. So with Derosa Capital 11, financing's changed a ton. And so we also got a ton more conservative, which forced us to raise a lot more equity and take on a lot less debt and be more conscious to what our loan to value ratios were and what our financial break even was on properties as we move into COVID and recession and all this other stuff.
Yep.
Right?
Yep. No, fair enough. I appreciate the clarity. So, okay, let's, the topic here is going from, so your largest capital raise prior to the most recent one was, right around $3 million. Yeah. And then you, most recently you've raised $7.5 million over a period of 3 months. And so let's talk about all the major changes that had to occur physically, mentally, with technology. I mean, like what are all the different steps you took to go from basically 3 and then more than doubling it in about the same period of time? I know you said that $7.5 million came over a 3-month period of time. I'm guessing the $3 million was probably right around the same period of time as well. But that's a huge jump. That's a massive jump. So please lay it out for me if you would, buddy.
Sure, no problem. So. And by the way, at 7.5, we're not even done yet. As I said, our total raise is 12. And so we've also learned about having to probably, as you're doing with a lot of your funds, we've got to keep the door open. Yeah. Like once you close the real estate transaction, you still got to keep working on a drip campaign to find the extra capital for construction, which is what we're doing. We raise enough to buy it and to get the first round of the property moving, but we're going to continue to do a trickle charge of capital to the property as we own it to fund the construction of it. Whole different, that is a different marketing tactic as well. So you don't just close your doors once you close on the property, you keep the conversation with your base going, and maybe you can convince existing investors to re-up their capital to go back in. But I'll rewind it there. What we found is, and then this is just you want to get people excited about what you're into. And so we found that a certain level of excitement's important going into a raise. I don't care if you're raising $100,000 a year, if you're raising $3 million, which is what we had done a lot of up until then. So we did a fairly heavy email campaign leading into a webinar, right? And so we would, heavy push emails to people to register for a Zoom webinar. We'd record this is totally not like a secret sauce here. This is pretty much what most folks are doing.
And not to interrupt you, how big of an email list?
Our email list is, we're not huge. Our email list is probably, because we've thinned it out of
quality over quantity, my friend.
About 2,500.
Yeah.
2,500 is what our database is. And I've talked to people that have like a 40,000 email database, but you wonder, like, how many of those folks have their checkbook out? I wonder, most of the people in our email database are able to cut a check if they like what we're doing. And I think that it takes the courage to thin the herd sometimes of looking at your email database and be like, this person I went to high school with, I'm sure they're a good cheerleader for me, but they may not, they're likely not going to cut a check. So I don't they're on my list, but I don't really count them as like a prospective investor. They're just maybe an advocate. Right. So I'm talking 2,500 real investors that could come into a deal. You got to kind of count them different. Right. So we sent that out. We sent out a regular email campaign where we use MailChimp, although we're thinking about switching over to what is it? Active Campaign. That's what my wife uses for her business. And she raves about Active Campaign. What do you guys use?
So for our investor stuff, we use IMS.
Man. Okay, we'll talk about that.
Yeah, but I mean, as far as like just we use we also use Active Campaign, not during our investment raises or anything like that. But so anyway, we use both.
Yeah. But those we'll talk about portals in a second, because that was one of the tech upgrades that we did, was we went to a portal. We were doing $2 to $3 million raises for mid-sized multi without a portal. And what a portal is for your audience, what a portal is this new tech that's super. It's great, way more expensive than they should be. that are out there because they kind of got you cornered, right? Like they kind of got the market cornered because there's only a few companies that do it, although there's more coming into it. There's more companies coming into the space that'll hopefully drive the price down a little bit. But what they are is a means for investors to log in to your website and see what your offering looks like. The portal will be their interface and help them sign their documents and help them enroll and commit to how much they want to put in. And then once the deal's up and running, they can log into that portal anytime they want and get their K1s for their financial obligations that they have to the IRS and stuff like that. Or they can, like, let's just say this is what was going on before we had a portal. Sally Smith would move, and she'd be calling me or emailing me or my admin or even my wife and saying, hey, I moved to a new location. Can you change my address in your system? Well, now with a portal, they can just log in and change that information. That's what's great about these portals is they really automate a lot of what syndicators and capital raisers can offer to people. So we went to a portal for this most recent one, but we did not use a portal before that.
Yeah, I think it's all about making it as easy and painless as possible for your investors to invest with you. I mean, I think you
got to Amazonify it, and make it as easy as buying something on Amazon.
I'm surprised that you've gone this far without a portal. So I'd love you maybe to share the differences of like the antiquated method to like now what your method looks like, because it's a pretty significant difference. Yeah,
man. In some ways, doing it without the portal was harder. With the portal was harder in a lot of ways, but doing it with the portal was more difficult in other ways too, right? Mm-hmm. Number one, there's a learning curve to using these things, right? And in some ways, there's just some techie glitches, and a lot of times, bottom line, a lot of investors that are passive they don't like, they're just not as tech savvy. They don't want to deal with it. They'd rather just deal with a live human. So we even had to circumvent the portal, and I had my admin just go and call them and talk them through it over the phone.
Yep.
And like even the portal's got the DocuSign built in there, and it's got the whole tech, and it's like point and click and all this other kind of stuff. We had my admin go through it by hand for a few people because they didn't want to do it that way. So before the portal, what we were doing was we were using like you would do the webinar. Right. And you create the sense of urgency, obviously, in the webinar, present the opportunity. This is what we got. This is what we're doing. This is what's amazing about it. This is what you ought to be concerned about. Like, here's the ups, the downs, the risk factors, all this other stuff. Present the opportunity. And then if you're interested, here's the next step. Now with a portal, go to the portal and set up a link for yourself and click on invest in the deal, right? It sounds simple. It's not. It's more complicated than that, even with all these portals, but that's what we would tell them to do. Without a portal, we would just give them a simple bit.ly link, and it was in their email inbox to fill out a Google form. Mm-hmm. Even more simple than that. Just what's your name, what's your phone number, what's your email address, how much did you want us to do a soft commit to the deal? Because the next step after a webinar, regardless using a portal or not, is to get investors to make a soft commit, right? What a soft commit is, hey, Kevin, I'm interested in what you're doing. And I think that sounds amazing. And I acknowledge your minimum investment's $50K. And so I'm going to commit to $50K or $150K or $300K, whatever it is. I'm going to make a soft commitment, meaning like, Kevin, put those shares on the shelf for me. That's what we explain this to investors anyway. Like, by them making that soft commit, it prevents us from being able to sell their shares out from under them. Now, there's a little bit of a scarcity mindset in there about like creating that sense of urgency, but also it's true because you hear about funds selling out. Right. And so to prevent a sellout that would sell out their shares from underneath that investor while they finish their due diligence and evaluate, that's where the soft commit's important. Mm-hmm. And so for us, then we kind of know who's interested enough to take it to the next level, who we want to pursue and finish that conversation with and have a one-on-one with or whatever. There's that. So you know who you're dealing with, and you know kind of what you have in pipeline to what you can at least count on part of coming in. That was our first step on just the webinars, okay. And the portal too.
Okay, got it. So that was one of the major changes you guys made in this last raise, this bigger raise. So that's the technology side of things. But what were some of the other big changes that you made in order to, again, just really accelerate or more than double the amount of investor, not necessarily interest, but final commitments, like stroking of a check and handing it over, saying, yes, I want to be a part of what you're doing?
Yeah. We had to manage, okay. With the smaller deals, it was easier in that sense because once they had filled out the form, then you could, it's a smaller, I hate to say this, but it's a smaller base, right? Like my deal that we did that had, with 3 million in capital, and I think our investor stack was like 24, 25 people.
Mm-hmm.
Right. So manageable. I can call all those folks in a day, right? The deal we just closed was 85 investors, right? And so it's just more heads to manage. And in some ways it becomes like herding cats. And you have to respect that when investors want to invest significant amount of money with you, $50,000 is a ton of money. Let's not just because we're talking in millions doesn't discount the fact that someone's hard-earned capital of 50K, whether it's out of the retirement account or whatever, is a lot of money, right? It is a lot of money. And so they are going to want to discuss that with you and that. And so you got to set aside the time to have those calls. On larger raises, you got to set aside more time. And so I had to have a few team members on my team step in and help me do those onboarding calls. Do you have your questions answered? Anything you need? And that. So we kind of took that database and divided and conquered it. Right. So you don't have attrition, because that happens on every raise. You have attrition, right? You have, some say you're supposed to raise 50% more than what you need in soft commitments, because they say you could lose. We don't lose that much, but we lose around, 20%, 15, 20% of commitments. And that's because that's with us staying on top of it and driving and trying to have a call with them quickly and working with them closely on their documents and things like that. You still have 20 to 25% attrition, which attrition in layman's terms means people that change their mind on investing with you.
Change their mind, or just something, a life event occurs. Yeah, something comes up. Yeah, things
scratch
happen.
Your head. It's like
a pandemic happens. So.
That happens, but also you scratch your head sometimes because you're just now remembering that your kid has to go to college next year.
Right. What is have you changed the minimum investments from last raises to this current raise, or is it 50,000? Is that what you've typically required?
We've always done 50K. We did a deal on a 40 unit with one of my students, and it was a really small raise. So we did 25K. I'll never do that again, because you know what? Everybody came in at 25K, and so it made it that much harder to raise. And anybody that had 25K also had access to 50K. So they could have done a 50K minimum, but most investors, when they want to try you out, are going to do the minimum. And that. So that was, especially if you're doing a 506B. So, the 506B, and it's going to be a lot of closer to minimum, which is okay. And it's also going to be a lot of retirement accounts, which is a whole nother animal to dealing with that with onboarding retirement accounts.
I'm assuming that. So I know your email list is 2,500 people. I'm assuming you hit that list up. You have that list, but I'm again, correct me if I'm wrong, in this last raise, you probably had to also figure out a way to create a broader reach than that of just your 2,500 investor list, right? Okay. So how did you go about doing that? Really reaching the masses versus just only focusing and relying on that 2,500 email.
Two things. You can't call all 2,500 people. You can't. It's not people like, oh, well, I'll do whatever I can and I'll call everybody. You're not going to get everybody on the phone. And so you got to chase you got to work with who's interested. And so what we would do, and this is an interesting tip, is we email blasted everybody. And we didn't do this on prior deals because we were able to, through emails and through webinars, pretty much fill the fund up. And then for those that had questions and wanted to, and that filled out a soft commit, we would have calls with them. Those are the only calls we had was soft commits. And I'll get to your question about how to raise knowledge too. But we ended up doing for the larger raise, what we ended up doing was we ended up making a ton more phone calls. And the phone calls we made were to anyone that registered for the webinar. Now you can make Zoom doesn't automatically do this, but when people want to go to your webinar, you want them to register, not just get the link to the open link to your webinar so that anybody can show up, right? You want people to register for your webinar so you can get what? Their name, their email address, right? You can follow up with them. But Zoom, you can also work other questions into the registration form on Zoom and make it mandatory. So we were like, what's your name? What's your email address? What's your phone number? Are you accredited? everything like that, right? You can go even further. What's your investment timeline? We didn't go there, but what are you looking to put in? What is your investment range? You can do whatever you want. Zoom is manipulable like that, right? So then we would take that Zoom list, and whether they were on the webinar or not, we would burn through that list and call everybody. Now, our first webinar had 300 people on it. So we had to go and call everybody on the list. So we expanded our call base beyond the soft commits, and we called all of our registrants for webinars, which is a way bigger undertaking to call all those people. That's the first tweak that we did. The second thing was, because we're 506C, and this is an interesting, 506C is a double-edged sword. For your audience, all that means is that you're working with folks that are accredited only, right? 506B, B stands for buddy. You're allowed to call your friend. You're allowed to bring in friends and family, and people that have a working relationship with you, or some that have a pre-existing relationship, and that's fine. But you can bring in non-accrediteds, and we had been doing those up until now. And we decided to try on a C. So we did. And that enabled us to do marketing, because you can solicit now. You don't have to have a pre-existing relationship. So we did Facebook ads, LinkedIn ads. We filmed. I have a pretty vibrant YouTube channel. So we filmed, for all intents and purposes, a summary. Some would call it a commercial for the deal, and put it on our YouTube channel.
I like that.
Yeah. And then we did that. And then you can advertise, you can pay, you can do push advertising, as how when you watch a YouTube video, you got to watch some knucklehead talking about something that you can't wait for them to stop talking so you can push the skip button, right? Well, I was that knucklehead. So I was the one you were watching before you did. We tried that. That did not work. That's called pre-roll advertising. We did that, and it's very cheap to get those ads. It's like pennies to get those in place.
But they didn't convert all that well, is what you're saying.
No, because I don't want to watch you talking about what you're doing, man. I want to watch the video. I didn't click on you. I clicked on the video with the Ferrari in it. I don't want to watch Matt talk about his deal. Get out of here. I'm waiting on it to go so I can skip. I have rarely watched one of those myself. I've got my fingers sitting over the skip button. We're all doing it, But what you can do is called a discovery ad. And what that is let's say you want to surf YouTube and you're like, I want to learn more about passive investing. I want to learn more about investing in North Carolina, whatever. And you can either Google search it, or you can search in the search bar on YouTube. What a discovery ad does is it puts your video just like you would see in an advertised Google search, right? Top of the fold. And it says ad next to it, right? And so it's an ad. It is YouTube will place your video at the top of people's searches when they search for things that are relevant to what your video is. That did really well. And that's way more expensive. It was like dollars per click versus pennies per click, right? And that. So that was what we went for. Was that, and that converted. And we got interest, and we got a lot of click-throughs, and we got a lot of additions to our investor database because of that. So I recommend that one. If you can get a video producer to come, it was an undertaking. We had to have a video production done. He's doing drone flyovers and stuff like that. It's really cool. And that. So we did that. It was like a 3-minute video. So tight, not like a 30-minute spiel on why my deal is amazing. Just a tight quick overview on it. Right. And then we just like a link at the end to learn more, do this. That was it. That one did the best. We also did Facebook, LinkedIn. We did Google pay-per-click. That cost me, I made Google richer on that one, but that didn't put anything in my pocket, the Google pay-per-click thing. LinkedIn produced a few leads that didn't go anywhere. Facebook ads didn't go anywhere either, but the YouTube thing went well. So,
did you guys were able to track how much capital actually came in as a result of that YouTube ad?
Yeah, we probably brought, off the top of my head, I think that, okay, so that's a loaded question. Because I think the first thing that those YouTube ads do is awareness, right? So I had an investor that was already in my database, already was aware of it, saw it, and took the link and forwarded it to me and says, hey, let's talk about this deal. He's already on my list, right? But he didn't make the webinar, didn't sign up for the other webinars, but he saw the YouTube ad and he took the link and he was like, hey, I saw this. I recognize you. I know I'm on your list. So that was like $50K, but I think that I could probably allocate like at least 200 that we raised, which isn't a ton, but we also got like 5,000 video click-throughs and watches because of that ad campaign, right? Now, maybe they didn't invest in Derosa Capital 11, but folks should look at the online marketing game as the long game. It's a marathon. It is not. We were trying to run it as a sprint and we produced a little bit, but I think that it'll be more of the long game for us as we continue to do it. And we don't have a deal right now, but we're continuing to advertise.
Yeah, no, I love that idea, and I agree with the long game. One of the strategies that we intend to roll out here on one of our future deals that we're buying, we're going to pick the right one that fits into the mold, but kind of an extended version of your 3-minute overview video. So more so an overview of the investment, which we could use to potentially drive some additional investor interest, but more so a follow-on case study, like a professionally done case study, on-site case study that goes through a massive value add or turnaround project and turn it into more of a short documentary, call it a 10 or 12 minute documentary, but in a series, a progressive series. I think things like that, and if even following it all the way through a refinance, very professionally done, just showing like, if you would have invested in this day one, this is what it looks like on, day 365.
Yeah. I highly
and this is what it
that.
took to get there.
People want to see that progressive unfolding of things. We've done a lot of that on our YouTube channel and on BP. For Bigger Pockets, we've done some, mini series things. We did a documentary of one of our apartment complexes called Fair and Square on Bigger Pockets that went really well. And we did like the deal we just did. Okay, the 336 unit we just closed in North Carolina. We shot a 4-hour, we didn't take 4 hours of it, but literally had our cell phones out the entire time that we drove down to go look at the deal. While we were on site, had the cell phones out and drove home and did the reevaluation, even called our mortgage broker and had the phone out and videotaped our phone call with the mortgage broker. Took that 4 hours of content and broke it down into a 30-minute segment, right? And turned that into a brief, like a mini show, right? And that one took off on YouTube because people want to see, it's real, man. People want to see the realness of it. And it's either just helping folks out and giving them some best practice ideas so they can go take down their own deal. I'm fine with that. Yep. But I believe it also produced some, at least plant the seed in people's head, investors too.
Yeah, well, I think what a video like that does is it you got a variety of folks that watch it. You got the folks that think they want to go do it themselves, and then you got the folks that have already made the decision, like, I don't have the time to do that. I just want to invest passively with a good operator that knows what he's doing. But what I think those videos do is, number one, is it adds additional credibility to the guy that he's already decided that he's a passive investor, that he wants to invest with a credible sponsor, and this just adds some more fuel to that fire for him to choose you. But what it really helps with is what that individual that has these grand visions of being an active investor that wants to do these big deals, that wants to be boots on the ground, that wants to manage it from point A to point Z. It makes them maybe second guess, and not that they might not be a good fit or that they couldn't do it, but it just makes them second guess. Wow, this is a lot more comprehensive than what I maybe originally thought. There's a lot more to it than maybe what some of the the YouTube videos or Facebook videos would make me think. Like, this has got me double thinking that I could probably actually get my money to work almost as well for me, just maybe being an LP versus a GP. And it just focus maybe on doing something, my day job or running my other business, whatever it is. And it converts some of those to a limited partner. And just they step back onto the sideline and say, hey, let me just put my money with you, Matt. You know what you're doing.
I think
I'd rather not make the mistakes.
We've had multiple people come to us, either from reading my book or from watching our YouTube channel, because people discount the work that you and I put in, as in operators like you and me, mine and your company, right? People discount that, but they don't realize how much there is. And so through things like YouTube, and there is an opportunity to show people all the different facets of operational landlording and entrepreneurship on the real estate side that it takes to make these things work. People think it's easy. It's far from it, and I mean, and it's passive. It's a good lifestyle in the sense that we might not work Monday through Friday, 8 to 5, but there is a lot to juggle and a lot to be present to. And so we've converted several folks that thought that they wanted to be active, that thought it was a lot easier than it really is. And I mean, God bless them. I'm glad I converted them because because I got an LP investor. So I have a new business partner. That's great. But also I probably kept them out of trouble by keeping them out of a space that they probably weren't prepared for, or they weren't aware that it was going to be as difficult as it actually is.
Yeah,
So,
no, I agree with that. One other question I had related to the capital raise side, it more relates to existing investors that have already committed. Let's just talk about this one particular deal. They've already committed some capital to the deal. Any specific strategies that you guys have utilized to encourage existing investors to up their overall investment? Maybe it's from 50 to 100, 100 to 200, whatever it might be. But have you guys utilized any strategies to encourage that additional capital to come in?
We have done that tactic on certain deals. When we had a rounding error, let's just say, you got a deal and you're looking to raise, and your raise target was, 3 million, right? And you get to 2.7 or 2.8, you're almost there, right? You could go bring more equity in that, but in that circumstance, I would just go to my existing $2.8 million worth of investors and say, hey guys, listen, I got great news. We're almost there. And I only need 200K. So if you guys all, maybe me too, you guys all kick in an extra 5% or 10% or something like that of whatever your commitment was, we can be there and not have to invite anybody else to the party, and we can be done and shut it down, right? I have used that method before because investors appreciate thinning out the herd a little bit and being a little more at the table with us, and just having less voices and less cats for me to herd, right? That's one thing that we've done. Now, in this deal, we didn't have to do that because we're raising for construction through the life cycle of the deal. We are hoping and intending that investors will continue to believe in us and see what we're doing, and continue to re-up and recommit capital every year to the same deal they're already in on, and fund construction. They don't have to, but they can. But we did do, Kevin, in this circumstances, because we raised and we started to hit a ceiling. When our raise goal, we were trying to get to, 7, 8, somewhere in there. And we got to around 3.5. Because what was interesting is that's what I had gotten good at, is raising between $2 and $3 million. So when I first launched this deal, I raised between $2 and $3 million, exactly what I had done in the past. So we had to change our game up. Yeah, and did a lot of things I'd already talked about. But the one thing we did more of as well was to have more like intricate level conversations with investors through the webinars, not about the broad deal, but about specifics about the deal. Like, let's do just a webinar on how Derosa Capital 11 can save you money on your taxes. Okay, let's do that. How about let's bring on a cost seg guy? We brought on Yoda Weiss, brought on my CPA. Did pre-recorded videos with them. Didn't bring them on the webinar. We just showed some pre-recorded segments with them, and we used those to talk about tax savings, about how cost seg and depreciation can benefit those that are filing taxes as a real estate professional, even if you're not a real estate professional, how it still saves you money. So we did that conversation. We acknowledge that the world is a little worried right now about COVID and recession. So we did a whole webinar just on how this deal is COVID and recession resistant. That's it. That was the only thing we talked about. Was COVID and recession. So those two webinars caused many of our investors to re-up their commitment, because they're like, hey, I actually can save some money here. So let me commit further, and then it also raised a lot more equity too. But importantly as well, some investors re-upped when they listened to those conversations about different facets of that this investment was a secure place to go, like a hedge against recessions and COVID, but it was also a good tax savings vehicle to save on income tax. So,
yeah, no, I love that. That's a great idea. Anything else? I want to move on here. We're running out of time. We've got about 7 or 8 minutes left, and I wanted to ask you a few questions about the pandemic, and just give everyone a general sense of when we're recording this, because it's going to be released shortly after. But October 20th is when we're actually here recording this. So the world is changing week by week, and so there could be some shifts based on the question and the answer that we go through here. But is there anything else, real quick, Matt, before we pivot to something else related to just really changing the game up and moving into this bigger capital raise, again, outside of some of the higher level points that we hit?
Yeah. I think that it was about, kind of keep continuing to tweak and change the game as we like. That was the biggest thing that I got out of it, is by not just staying the course and keep doing what you've been doing and keep pushing, just continuing to try new things. Yeah, I flopped on LinkedIn ads and I flopped on Facebook ads, but I'm grateful I tried it, and now I know more about how to do those a little bit better, and Google pay-per-click and stuff like that. We tried those things. We tried one webinar model that didn't work. Nobody wanted to hear it. We only had like 10 or 15 people on. Okay, let's not do that again, But I think the biggest thing that I got is for anybody trying to raise capital or trying to assemble a real estate transaction, don't be afraid to try on a few different angles to gain interest and to market your deal and that. And we tried a lot of different things, and like half of them worked. And we made it. We hit our goal. So.
That's great advice, man. I appreciate that. And just again, I want to pivot real quick here, and then we'll work to wrap it up. I would just want to talk about the pandemic. And again, we're recording this on October 20th, and just more specifically, have there been any major changes of how you run your real estate business, how you operate it, any major shifts that you've had to make as we roll through these challenging times? I mean, just that's a very broad, general question.
Yeah, it is. I mean, if I look at the way I felt about things in March, April versus the way I feel about them now, I'm a lot more hopeful for the world. I'm more hopeful for, I wish I could fast forward past November the 3rd, and somebody listening to this could tell me what happens on November the 3rd so I can rest in peace here. But I think that America will get to a lot more stable place after that. I sure hope so anyway. After they've accepted the results and we all moved on and get back to our lives and quit worrying about, things we can't control and all that. Right. I think that I'm feeling a lot more hopeful about things in general. And I think that what we've done, to answer your question, we're heavily communicating with investors because they were just as scared as we were in March, April, May in there. Right. And so we over communicated. We asked our property managers to over communicate with tenants. And so I think over communication was like the underlying theme of what we did during COVID with investors and with tenants and with our staff, about how we're doing, what's working, what's not working. And we would take best practices. Okay, this site tried this and it worked. Like we had a site give the tenants like a 15% discount for paying their rent on time. Right. Nice idea. Didn't work because the tenants that pay their rent on time are going to pay their rent on time. The tenants that don't pay their rent on time are also not going to pay their rent on time, right?
It's funny. We did that in a few communities and it completely backfired on us. The same thing. Yeah. We only did in like two of our New York communities where we're having some bigger challenges than others, and it completely backfired.
I was like, that was a dumb idea. Let's not do that again. Our PM did it in April and they wanted to do it again in May. And I'm like, no, don't do that again, man. You just took 15% out of my pocket for no collections they were the same. They were actually down 15%.
Your heart was in the right place. You know what I mean? I think that's what it was all about. It's just really trying to find a path for folks that were having challenges and issues to find the means to pay it. Encourage them to find, means to pay it. So
what worked better was, number one, aiding tenants and finding a path to support. Right. And asking the PM to hands-on work with them, call Johnny up and tell him, hey man, listen, you can call Catholic Charities, Section 8, here's their phone number. You can call the local rescue ministry. You can call all these folks. These phone list of people can help you. Would you like me to call them with you? Whatever. So that helped. Also extending like late deadlines and being like, hey, listen, just get it to us by this time. We're not going to charge you a late fee. And being more open and communicative and not trying to drop the hammer on people, and being being in communication. That worked versus financial discounts, man. And I find that just accessing the human side of this is what worked the best for us. And those that could pay did. And we got a few people that decided to work the system and are reading enough newspapers to figure out that we couldn't evict and everything like that. And they squatted, and I got people right now that haven't paid us since March. We
have a few.
Yeah, I got a few of those. But I submit to you that that's the world. And you're going to have people that's just they're going to be on the take like that. And it's got nothing to do with where they live, with what their what their creed or color or anything like that is. That's just their mentality. It's a scarcity mentality. Oh, I don't have to pay, so I won't. They're not thinking the long game in that. Now, we've been able to get a few of those folks out through Cash for Keys. But there's others that have figured it out. Like, oh, I'm just going to hang out here until I don't have to, until I can't anymore. But they're in the minority. They're like in the 5% range of our portfolio.
Yeah, no, I agree. I think we can all go to sleep at night knowing that the majority of the world are good people. There's a few select
That's
idiots.
The best thing I learned out of this whole thing, Kevin, is I got a lot of hope for humanity through this. Yeah. And the media doesn't want you to have hope for humanity and all that, nope. But the media is like, oh my goodness, it's all falling apart. I found a lot more solstice in in comfort in the goodness of people, and that if they can pay, they're gonna. Most people are, Yeah. There's a-holes out there, but they're not going to pay you, but that's okay. But most people do, and most people are good humans, and I got a lot of comfort in society through that.
I agree, brother. Yep. Yeah. We're on the same page there for sure. Well, Matt, this has been a lot of fun, man. Always good to catch up with you and have you on the show again. It's been, I didn't even look back, but it's been a number of years, probably like 3 or 4 or 5 since you were on the show last time.
Let's do it again sooner. Let's not go 5 years again.
But before I let you go, again, you shared a lot of great info. Before I let you, I'm not letting you off the hook that easy.
Sure.
I'm going to enter into what I call the golden nugget segment. I'm going to ask if you just leave our audience with one final golden nugget of advice or wisdom that might inspire and motivate them as they progress in a real estate investing career. What would that one last golden nugget be, buddy?
Oh, that's great. So this is it, man. We talked about a lot about this during the capital raise and how I kind of muddled my way through a way bigger capital raise than we're used to and everything like that. And that is, don't quit. When things get tough, man, don't quit. Just try on something new, and have faith and just try something new to get you to where you want to go. When times get tough, it's not a time to drop your goals. It's time to just try a different method to get there, and there's a lot of times that we could have quit and walked away from this deal, but we didn't. We just stayed in and pushed and got it and got it done. And so I have a lot of gratitude for, kind of digging deeper, finding another gear and finding a way to get there. And so that's my nugget, is that if you're committed to something, stay committed to it and just keep trying on different methods to get to where you want to go, and you will get there. Something's going to work. A lot of things won't, but some things will work, and you'll hit your target.
I love it, brother. Love everything about it. Tell our listeners how they can learn more about you and your group and what you guys got going on.
Sure, man. Thank you. Just derosagroup.com. That's my company website, DEROSA, derosagroup.com. They can pick up a copy of my book there. They can check out our YouTube channel, my wife's show, The Real Estate Invest, her show documenting the journey of the real estate investing woman. And so lots there, Derosa Group. And for those that want to consider passive investment with us, that's there, all there too. So derosagroup.com.
Okay, good deal. Matt, pleasure always having you, buddy. Good seeing you again.
Great to be with you, Kevin. Thank you.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Buffer, wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.